Joining me is Meyer, the chief economist and head of the Mastercard Economics Institute, along with CNBC senior economics reporter Steve Liesman. It's great to have you both here. Michelle, it's great to check in with you today and kind of get the pulse for where we are. A lot of people are worried that excess savings are running out. We've heard from the dollar stores that those lower income consumers are running out of cash by the end of the month. They're putting off some of their discretionary spend. What gives you reason for your optimism?
Well, I think it's a variety of factors. Even today's report, in terms of looking at what the Census Bureau released, I thought it was strong across the board, 0.7% month-over-month total, the core control of 0.4%. If you look at the last 3 months on an annualized basis, running at 5.6% in terms of core control spending. So there's momentum. The consumer has been active now, not only just for this holiday season, but we've been seeing certainly that trend when we look at the last several months of data here. So I do think the consumer is supported. I do think the consumer is engaged, and we're seeing that spending. Specific to the holiday season, we saw a really targeted consumer, right? The consumer engaged when they thought they had the most amount of value, promotions, this big surge of activity right for the Black Friday period. And that seems to be continuing into early December as well. So
a trader friend of mine who's quite bullish is still wondering or kind of anticipating that the consumer becomes a little bit more muted next year. Here are a couple of reasons. Thinks the unemployment rate will trend higher. Student loans need to be repaid. Credit card debt. I might add to that, as Steve and I have been discussing, kind of this potentially lower trend in hiring among small businesses. So while things kind of look okay now, you spin it forward 6 or 12 months, you think we're still in that same boat?
I think the consumer has been well supported, and I think continues to be well supported, right? When you think about the conversations we've been having for the last 2 years, there's continues to be this underappreciation of the resolve and the ability of the U.S. consumer to engage. There's also an underappreciation, frankly, of the labor market as well. Right? We've seen job creation run in excess of expectations, in excess of what was perceived to be the underlying trend for the last 2 years or so. So to me, it's a business cycle that has exceeded expectations. We continue to see growth. Yes, there's reasons to monitor. We have to look at a variety of different risk factors. But also remember, when you think about balance sheets, we've had a very positive wealth effect for those that have been able to participate. And now interest rates are coming down.
Yeah. Steve, jump in here. I think the autos piece of this is interesting, and I noted that Eric Rosengren had a tweet where he basically said, if a lot of this spend was autos, and if consumers were pulling forward those purchases in anticipation of tariffs, now I'm not sure I totally buy that line of reasoning, but then could we face kind of a hangover into next year?
Look, Kelly, you don't pay me extra for this, but I want to explain why you were uniquely smart to start the show thinking about retail X auto.
You know,
that number was very high.
It's all Tory.
Well, whoever it is, the reason why is this. That auto number was likely affected by two factors. One is hurricane replacement. When you have big hurricanes like this, the cars take it on the chin in a big way. And so people have to replace cars. The other thing might be, and I don't have evidence for this, it's speculative, is that people buying EVs ahead of perhaps the elimination of the tax credit in the incoming administration. So that's a question for Phil LeBeau. I've not had a chance to report, but it is some speculation out there in the economics community, which is why getting rid of all that nerdy stuff, you really focus on the X auto number, and that's okay. I don't disagree much with what Michelle is saying. The consumer, I think, is hanging in there, but my caution is do not take it as an acceleration here of the consumer. Consumer seems to be hanging in. If jobs remain okay, if income remains okay, salaries go up along with inflation and productivity, I don't think the consumer is going to give it up. But I just don't think I would be head faked by the idea that this auto number pushed up the retail sales number to think the consumer is reaccelerating here.
And I'm playing devil's advocate a little bit because, I mean, this is such the kind of economy where you look around and think, okay, we've gotten to a point, we have wage growth still, unemployment rates low by historic. Like, I'm not trying to create problems where there aren't problems, Michelle, but I am curious what you think the Fed should do. I mean, do they need to cut this week? Do they need to cut next year?
Well, look, I think it's very well priced in that they will be delivering the 25 basis point cut tomorrow. And I think that's very reasonable when you think about the success that we've seen so far in terms of inflation. Right, the level of interest rates is still high given the trajectory that we've been on for inflation. But the big question, I think, for monetary policy is to try to determine where equilibrium rates are. What's that goalpost? They feel pretty secure throughout this year that rates were too high given the progress for inflation. But as we look into next year, we try to understand where inflation stabilizes, where the real economy stabilizes. Probably going to be seeing a little bit stickier, higher inflation. We've been seeing higher underlying growth relative to expectations. Could it be the case that therefore interest rates should be also a bit higher? And trying to figure that out, I think, is going to be really tricky. So my sense is tomorrow from the Fed, we're going to see that 25 basis point cut. And then we're going to hear a lot about data dependency and figuring it out as they go along. Our baseline forecast is for 75 basis points of cut next year, but we're going to have to monitor that data as well.
I want to get you on the shadow Fed, Michelle. I think that would be very fun. When we have an opening, I will nominate you. How's that?
I'll take that nomination.
Michelle, thank you as always. Michelle Meyer with Mastercard. We appreciate it.